Hello, this is Rick Wallace. Today I want to talk about simple numbers, really the key to profit. This is from a book called Simple Numbers by Craig Crabtree, but it is a format by which you can take the numbers that are very complicated in most of our businesses and simplify them down to just a few key ones you want to look at that can really leverage your profit. Because after all, profit's why we're all here, or it better be. It's why you're taking this course and looking at this information. Without profit, there's no return on this investment you're making, not only in your time and your life, but the money that you're putting into this business. You need to make a profit, and that means more than 5%. It means closer to 10 to 15% return on your investment and a profit, net profit in the company. When that happens, cash flow is not a problem, and other issues that keep you up at night go away when you're running a profitable business. You know, it's kind of funny. There's a cause and effect to profit. You know, we all want a business that works for us versus one that relies on us to work. We want great people working there. We want to be around great people. We want great people working with great people because A players want to be around A players. We want our families prospering, and we want a great place to build a career and come to work every day. That's kind of success if you think about it, and you can't have those things without a profitable business, and you can't have a profitable business without those things in place. Because success to me is, I borrowed from a guy in Australia, but you've heard me say it before. Success is doing what you want to do, when you want to do it, with whom you want to do it with, and in a manner you want to do it. Without profit, you can't be successful. So what we're about to talk about comes from a book called Simple Numbers by Greg Crabtree. He kind of brought me and my clients out of the darkness. Many people in small businesses don't even understand their numbers. They're complicated. Those that do understand them, we spend a lot of time with those old beliefs that I had about, you know, making a profit meant I need to raise my prices or I need to cut my expenses or both. And nothing could be further from the truth. The most powerful levers of profitability in your business are gross margin and the productivity of your people. And that's what we're going to learn about, getting all those complicated numbers down to 3 or 4 key numbers that we got to look at that will leverage the profitability of our business, and not to waste time on numbers that we really can't do much with, or if we do reduce, are going to be in such small numbers that they're not going to have any effect on our profit, but will waste a lot of our time. Greg talks about the most challenging level of profitability for any small business is between $2 and $3.5 million in revenue. And the reason is, before you get to that size of 2 million or so, you know, you can run the business pretty much by yourself, wearing a lot of hats. You've got a few employees that are working for you that are handling the stuff that you can't get done. They're kind of supporting you. But when you get to $2 million to $3.5 million, the business gets too big, and it's hard to bring in management levels and other people and still make a profit. So we want to position our company so that if we're in that area today, we can get out of that area and start making a profit, or if we're growing to that level of revenue, that we do it in the right way so that we're prepared for that black hole of $2 to $3.5 million. 10% profit is the new break even. If you're not making 10% in pre-tax profit legitimately, then you probably got cash flow issues. There's times when it's tight, times when you have to tap a line of credit, stay up at night worrying about those kind of things. And it used to be that, you know, 5% maybe was break even, or we felt like we were doing pretty good at 5%. It's just not true anymore. You can't get your cash flow positive. You can't build a great business and unless you're in the 10 to 15% in pre-tax profit. We're all trying to build a company that has some value, has some equity value in the future. Whether we want to sell it or whether we want to turn it over to others, kids or whatever, but still cover our retirement. We need to build a business that is worth more than just the assets. Businesses that have cash and no debt attract magical things. So that's our goal. Our goal is to build a business that's making 10 to 15% pre-tax profit year after year. And we're building equity in the business by little getting out of the business and the day-to-day operation, and having a business that really doesn't rely on you to work, but works on its own. So as I said, consistent profit builds equity. The core capital target is hit, and there's cash. The core capital is having set aside in cash 2 months worth of operating expenses, so that when you hit any kind of little slow spot, you've got money in the bank to be able to cover your expenses. The ideal scenario is true wealth building is building a company that is profitable, 10 to 15% pre-tax profit. So revenue is a vanity number. Gross margin dollars are the money you have to invest and spend in your business. So from now on, think of revenue only as a vanity number. Really what you want to do is grow your gross margin dollars. That's where the profit's going to come from. For every gross margin dollar, it's equal to anyone else's, but every revenue dollar is not. You know, I do extensive benchmarking with many of my clients, and let's say that Bill, he's running 52% gross margin in his business, and Rob's running 60% gross margin in his business. So for every Bill's dollar of revenue is only worth 85 cents to Rob's. So if we looked at revenue and compared them, they'd be equal. But when we look at gross margin dollars and profitability, Rob is going to be much more profitable. The value of gross margin dollar is the same to everyone. The value of a revenue dollar is not. Okay, so this is a very important part of this whole presentation. That is that you've got to start looking at labor as an investment, not an expense. On your P&L, labor is the biggest expense we have. I don't care what the business is, it's normally the biggest expense. And we got to stop looking at it as an expense and look at it as an investment. What is my return on that investment? That's the question we ask, and that's why I say treat it as an investment, because if it's an investment, then we're not looking at what we're spending as much as what we're getting in return. If we go to the bank and give them $100, they give us $150 back, we'd be going to the bank every hour on the hour. So that's what we got to look at. An example of that is a Container Store. And time after time I hear people saying, you know, I can't afford A players, and I can't pay that, or I can't afford to pay that for this position. And I want you to get away from that thinking. What you need to be thinking about is, what is the return I'm going to get for that position if I pay this much? What is the person I'm getting? Container Store, Skip Tyndall, great company, grown tremendously, doubled their revenue every couple of years, number of stores, and his whole philosophy is he hires the best and pays them better than the industry. And he found that by getting A players in his retail store and only hiring A players, he runs those stores with a third less people than any other retailer. So what he's doing, he's paying them 30, 20, 30, 40, 50% more than the industry average, but he's getting people that can do 3 times bring 3 times the gross margins, 3 times the revenue, 3 times the productivity of just an average person that he'd hire off the street. So you got to look at labor as an investment, and only then can you afford to hire A players in every position in your company. So remember, labor productivity is the #1 thing that determines whether or not you are profitable. We're going to show you some numbers, and those numbers are key to profitability. And we'll talk a little bit about how to affect those numbers. So we're going to focus on the gross profit per labor dollar as your key indicator of labor productivity. And let me say profitability, because you'll see a direct correlation. So let's look at the 3 keys to unlock your business potential. The first one is remove distortions. Are you looking at true numbers and understand your true targets and goals? So that's what we're going to talk about first, then labor productivity, and then the four forces of cash flow. What do I mean by common distortions of profit and loss? First is owner's comp. Are you paying yourself a market-based salary? In other words, someone in a business doing what you do every day, what should you be paying yourself? If you had to replace yourself in your business, what would you have to pay that person to come in and do what you do? That needs to be in your books, and you need to be taking that salary. That's the only way you can get numbers that make any sense. It's easy to get 10-15% profitability if you're paying yourself $10,000. So you first have to start paying yourself a comparable salary to what you'd get in the marketplace or to replace you. Don't look at percentages, look at dollars. You can't spend percentages. What is a month? Not all months are created equal. So anytime you're looking at your numbers, always first look at the last 12 months together, and then look at the month that you're in or the quarter that you're in. Misaligned cost or revenue. All costs should be in the same month as booked revenue. So it's always trouble when you've got some product costs or other costs that are moving from one period into another. Always make sure that the revenue that you book has the cost associated with that in that same month. Mixing labor and non-labor, we'll talk about that. And the cash flow versus profit. Cash is king, as we know. So removing the distortions, what are the action items? Well, first simplify your P&L, and we'll talk about that in a moment. Take all those accounts and all those expenses and everything, and let's solidify them into a easier to understand and put them into buckets that we actually can do something about or attack. Accurately report owner's compensation. As I said, what is the real compensation you should be paying yourself or you'd have to replace yourself with? Focus on the true numbers: gross margin, contribution margin, the right pre-tax margin, profit margin, and then view the financials in a rolling 12 months. Understand what paying taxes really means, because too often we do things at the end of the year to keep from paying taxes, and the only way you can build wealth is to pay taxes. I don't want you to pay more taxes than you owe, but we shouldn't be doing stupid things to save 30 or 40% in taxes. Greg talks about spending $1 to save 40 cents. Doesn't make any sense. If you don't need that new truck, don't buy it at the end of the year just so you can save on taxes. Don't push revenue and gross margin and profits into next year because you don't want to pay taxes on them this year. All you're doing is just kicking a can down the road. So be a good business person and try to maximize the amount of taxes you're paying, because you're going to maximize your profits every year. That's the only way you can build wealth. So first, we talked about revenue. It goes up at the top of the list, but it's the vanity number. Cost of goods sold, that is what you pay for the goods that you're selling, and that's not your money. Direct labor costs. Do not mix labor with non-labor. And here's what we suggest as far as expenses. Don't put a whole bunch of lines on your P&L and create a whole bunch of noise and a lot of distractions. Break it down into facilities, marketing, management and administrative labor, sales labor, payroll taxes and benefits, and other operating expenses. Other operating expenses and income or depreciation, interest, etc. So break all those down into those, consolidate them down into those 6 categories. This is what we recommend as the simplified P&L, getting it down into simple numbers that you can understand and that will drive profitability. There's 2 companies here. One's a construction company, one's a service company. And the interesting part of it is that, of course, the construction company buys a whole lot of stuff that they don't mark up much. And their gross margin percentage is pretty small. They're doing $20 million in revenue, but only $2.85 million in gross margin. Service company, on the other hand, has really got very little cost of goods sold. So their percent of gross margin is much higher, but on $3.7 million in revenue, they generated $2.85 million in gross margin. So from that standpoint, these companies are very equal. They then take direct labor, and that is touch labor. In the case of service company, it would be technicians, people that are generating revenue and adding value to the products. Construction company, it'd be their laborers, of course. You subtract that number from gross margin, you get contribution margin. In this case, you see they're very equal. Now, direct labor LER, what is that? That is labor efficiency ratio. And the way we get that number is dividing our direct labor into our gross margin number. So for every dollar we're spending on direct labor, we're getting $2.85 in gross margin. Now we go to operating expenses. Instead of a lot of different numbers and a lot of different lines, we recommend making it very simple, because there's not a whole lot you can do in those areas to increase your profitability. So why have all that noise on your P&L sheet? So break it down into facilities. What am I spending on my facilities? What am I spending on marketing? What's my management and administrative labor costs? Payroll taxes and benefits, and other operating expenses give me total operating expenses. So what I do, of course, is subtract my total operating expenses from my contribution margin, and I get the net operating income of $625,000. I then divide my total cost of labor, both my administrative here and my direct labor, into my gross contribution margin number, and I get $1.63, which means for every dollar I spend on overall labor, I'm getting $1.63 in contribution margin. I can do the same thing with my management administrative labor. I divide the total cost of that labor into my contribution margin, and I get $2.47. So then I go down and take depreciation, interest income, and come up with a pre-tax net profit of $525,000, which is 2.6% of revenue in the construction case and 14% in the services company. But a better way to look at this is, what is my percent of gross margin, pre-tax income as a percent of gross margin? And as you can see, it's equal in both cases, even though there's a big discrepancy in the amount of revenue. So as we said, not all revenue dollars are equal, but all gross margin dollars are equal regardless of the business you're in. So as a review, direct labor is the key to productivity. Direct labor efficiency ratio. All employees that spend the majority of their time, 50% plus, delivering direct value to clients, servicing products, building products, repairing, all those kind of things are direct labor. Usually we call it touch labor. They're touching things and adding value. Do not include benefits and taxes, and ideally it can be viewed by client, project, and segment. So your direct LER, direct labor LER, you divide your direct labor costs into your gross margin, and for every dollar I spend in direct labor, I'm getting X amount of dollars in gross margin. Sales labor. What's sales labor? I didn't mention that in the deal, but we need to have that also. Any outside, inside salespeople, customer service people, counter people, sales managers, if they carry a quota. If they spend 50% of time or less in the field, then they would be into management and administration. So how do I look at this? Sales labor efficiency ratio. We take our sales labor costs and we divide them into contribution margin. And that gives us, for every dollar I'm spending on sales, I'm getting X number of dollars in contribution margin. So you could base incentives on contribution margin. You could review your direct labor by client to find patterns. Not all revenue is created equal, as we said. So we want to incent people and get our sales operation looking at contribution margin. How much contribution margin am I producing? And then train them on what that means and how to maximize the amount of contribution margin they get in all their sales. Same thing with management administrative labor. If you spend less than 50% of your time interacting directly with customers, then you're in the management labor area. It could be probably as you, it could be other people in the office, that are working on the books or doing other things internally in the operation. Answering the phone, doing marketing, office, bookkeeping, sales and service managers that do train and coach over 50% of the time. All these people belong in management and labor, management and administrative labor. The LER for that is, again, taking their cost without their without their benefits and payroll taxes, just their salaries and bonuses and commissions, and dividing that into contribution margin. And again, I'll find out what my investment is returning. For every dollar I spend on management and administration, how many dollars am I getting back in contribution margin? So these are the numbers and the KPIs that I propose and that Greg proposes looking at if you want to really move the needle on your profitability. Gross margin per full-time equivalent. That's just another way of looking at, what is my productivity? Sales labor efficiency ratio, service labor efficiency ratio, or direct labor, management administrative efficiency ratio, and you can actually look at your marketing efficiency ratio by dividing the cost, all the total cost of your marketing or investment you're making in your marketing, and what is the return in gross margin from that investment. It's just another way to look at it. Now, once we establish those numbers, now we start setting goals, and now we start training people, and now we start hiring people that are going to increase the effectiveness and efficiency of our operation. And as our efficiency goes up, those numbers are going to go up, and I guarantee your profit's going to go up. You can actually go back and look at various quarters in the past when you're really cranking and doing really well. Calculate these ratios, and you'll see that there will be a direct correlation between these ratios and the profit you're making. So establishing that benchmark of where am I at right now, going back and looking at other quarters in which you were doing really well, and looking at these KPIs, now we can set goals to get back there, and we can start training and working and coaching and hiring the right people and making that investment in labor, because that's what it's all about. It's what's the return I'm getting on my labor dollars. With that, we'll be talking about cash flow and other things in the rest of this lesson. Thanks.